18.5%. Let that sit for a second. Right now, today, as you watch this, silver is trading at $94.50 in the West. And in Shanghai, the exact same metal is changing hands at $112 an ounce. That is a $17.50 gap between two markets that are supposed to be pricing the same thing. And that gap is not closing. It is widening if you hold silver. Physical silver, mining stocks, a silver ETF inside your IRA or your SIPP. What I am about to show you in the next 20 minutes may be the most important framework you have seen all year. Stay with me. Last week I told you to watch the DXY, the US dollar index, specifically the 99 level. I said if it broke below 99 and held, that would be a structural signal, not just a technical one. Here's what happened. The DXY did not just break 99. It dropped all the way to 97.61 over the weekend. That is not a dip. That is a move. I called it, it hit, and I want to be straight with you about what that means for everything we are looking at today, because it is directly connected to the silver story I am about to walk you through. My name is John. I spent 15 years working inside currency and commodity markets before I ever picked up a camera. I have sat in rooms where positioning decisions get made at the institutional level. I watched, year after year, what happens when retail investors get the wrong information at the wrong time, when they chase headlines instead of data. That is why this channel exists. Everything you're going to see today comes from publicly available sources, and I will name every single one as we go. No URLs, no rabbit holes, just the data plainly explained. Today you're going to understand exactly what COMEX backwardation means and why it matters right now, why the Shanghai premium is the most important number in precious metals this week, and how to use the 3 lanes framework to separate the noise from what actually requires your attention. If this kind of calm, data-first analysis is what you've been looking for, hit the like button right now. It tells me to keep making these. And if you are not subscribed yet, do it now, because what we are building here week by week is a picture that gets more valuable the longer you follow it. So let us start with where we actually are. Gold is sitting at $5,278 an ounce as we head into the Monday open. Silver is at $94.50. 3 weeks ago, silver was trading significantly lower, and if you're holding physical, you have felt every dollar of that move. Now here is what triggered this video specifically. Over the weekend, Middle East tensions escalated again. The details are still developing as I record this, but the safe haven bid that came in was immediate and it was large. Gold and silver both surged in weekend trading before Western futures markets could even respond. And that is where it gets interesting, because the gap that opened up between Eastern and Western pricing this weekend did not appear out of nowhere. It has been building for weeks. The question this video answers is simple. Is this a temporary dislocation that corrects itself, or is something structural happening underneath the surface? And the answer, when you look at the actual data, is more complicated and more important than most channels are telling you. Before we go further, drop a comment right now. Are you seeing elevated premiums at your local dealer this week? Or has it started to normalize where you are? I am talking physical premiums over spot. What dealers are actually charging above the paper price? That comment section becomes a real-time sentiment tracker, and I read every single one. Now here's the core of what is happening, and I want to take you through it carefully because there are 3 separate signals all pointing in the same direction at the same time, and that combination is what has my full attention this week. The first signal is the Shanghai premium. When I pulled the Shanghai Futures Exchange data heading into this weekend, silver in Shanghai closed at $112 an ounce. Western spot was $94.50. That is an 18.5% premium, $17.50 per ounce. Now to put that in context, a small premium between Eastern and Western silver markets is completely normal. It reflects local taxes, financing costs, market structure differences. A premium of 2 or 3%, not unusual. But 18.5% is not a market structure difference. That is a physical demand signal of a completely different magnitude. Think of it this way. Imagine 2 petrol stations on opposite ends of the same motorway selling the same unleaded fuel. One charges £1.50 a liter, and the other charges £1.78. For a moment you think, Okay, maybe one has higher rent, higher staff costs. But if that gap holds for days and keeps widening, at some point you stop explaining it away and you start asking who is buying every drop from the expensive station and why they cannot wait to drive to the cheaper one. That is what an 18.5% premium tells you. Someone in Shanghai wants silver so badly right now that they are paying nearly a fifth more per ounce than the Western paper price. And the Western paper market has not caught up yet. That lag is the story. Hold on to that thought, because in about 6 minutes the CFTC positioning data is going to add a layer to this that completely changes how you read what I just said. The second signal is what is happening on the COMEX itself. And this is the one that I think is most underreported this week. While spot silver trades at $94.50, front-month May futures on the COMEX are sitting at $90.40. That means futures are cheaper than spot. In a normal, functioning market, futures trade at a premium to spot. You pay a little extra for the certainty of delivery at a future date. When futures trade below spot, that is called backwardation, and it is one of the most reliable signals of acute physical tightness in a commodity market. What backwardation tells you is that the people who need physical silver right now are willing to pay more for it today than the market believes it will be worth in the future, because they cannot wait. They need the metal. Now here is where the COMEX warehouse data makes this even more interesting. When I looked at the most recent CME warehouse report, and I want to be clear, Creator, verify this exact figure before recording. Registered COMEX silver stocks, the metal that is actually available for delivery against futures contracts, has been drawing down. Over 100,000 silver contracts are open in near months on the COMEX. Each contract represents 5,000 ounces. The math on what full delivery would require versus what is actually sitting in register vaults is the kind of number that explains why the word squeeze gets used in the same sentence as COMEX silver. I am not saying a COMEX default is imminent. That would be a prediction, and I do not make predictions. What I am saying is that the gap between paper obligations and physical availability is worth watching very carefully right now. Stop. Before we go any further, I want to show you something that actually cuts the other way. Because one of the things I committed to when I started this channel is that I will always tell you what the counter-argument is, even when the setup looks compelling. The bearish case for everything I just described is this. Premiums can compress fast. If the Federal Reserve signals any surprise hawkishness this week, any hint that rate cuts are off the table or that hikes are back on, the dollar rallies, real yields rise, and silver paper positions get liquidated. In a hurry. We have seen it before. A margin call does not care about physical fundamentals. Think of it like a tenant who put down a small deposit on a big apartment. The landlord suddenly triples the deposit requirement overnight. The tenant did not change their mind about the apartment. They just ran out of room. That is a margin call. And a wave of margin calls can drag physical prices down even when the underlying physical demand story is completely intact. So keep that in the back of your mind as we go through the rest of this. The third signal is the macro backdrop, and this is where the DXY call from last week becomes directly relevant. The U.S. dollar index at 97.61 is not just a number. The dollar and silver have an inverse relationship that is well documented. When the dollar weakens, dollar-denominated commodities become cheaper for foreign buyers, and silver, priced in dollars globally, becomes more attractive to every market outside the United States. At the same time, the U.S. 10-year Treasury yield has dipped to 3.96%. Silver and gold are zero-yield assets. They pay no interest. When Treasury yields are high, holding metal has an opportunity cost. When yields fall, that cost disappears. Right now, both of those traditional headwinds for precious metals, a strong dollar and high real yields, have removed themselves from the equation at the same time. The Congressional Budget Office data on U.S. fiscal trajectory, Creator, verify the most current figure before recording, continues to show a deficit path that is structurally dollar negative over the medium term. I am not saying the dollar collapses next Tuesday. That is not how this works. De-dollarization is a decade-long structural process. It is not a Tuesday event, but the direction of travel is visible. It is documented, and a DXY at 97.61 is consistent with that direction. If you know someone who has been watching silver this week and genuinely cannot make sense of why prices are moving the way they are, share this video with them right now. This breakdown took time to put together, and the people who need it most are probably not searching for it themselves. Now, let us zoom out to the geopolitical layer because this weekend reminded us that these markets do not exist in a vacuum. The Middle East escalation that unfolded over the weekend fed directly into the safe haven bid we saw in gold and silver. Gold at $5,278 heading into Monday open reflects that bid. But here is the nuance that most of the coverage misses. Gold and silver respond differently to geopolitical risk. Gold is a pure safe haven. It goes up when people are scared and comes back down when the fear subsides. Silver has that same safe haven characteristic, but it also carries industrial demand underneath it. So when silver surges on a geopolitical shock, you are getting two forces at once: the fear bid and the physical industrial demand that was already there. On the central bank side, the World Gold Council data, Creator verified the most recent quarter, continues to show net central bank buying of gold at a pace that represents a multi-decade trend. These are not traders. They do not check price charts every morning. When a central bank reallocates reserves into gold, that is a multi-year structural decision, and the direction of those decisions consistently has been away from dollars and toward gold. For the UK viewers watching this, the London Bullion Market Association Vault data is worth monitoring closely this week. The LBMA is where the world's largest physical gold and silver transactions clear. Any unusual withdrawal activity from LBMA vaults in the coming days would be a significant secondary confirmation of everything we are looking at in the COMEX and Shanghai data. The Bank of England Reserve data is also where to look for any shifts in UK sovereign positioning. The industrial demand piece underneath all of this is not going away either, and I want to spend a moment on it because it is a part of the silver story that does not get enough attention when the geopolitical headlines dominate. Silver is not like oil where you can watch it burning. It is inside electronics, solar panels, medical devices, EV connectors, AI server infrastructure, dispersed in tiny amounts across enormous industrial systems. The Silver Institute, whose annual supply and demand data is the most comprehensive available, has documented a structural supply deficit in silver for multiple consecutive years. Creator verified the most current deficit figure from their published report before recording. What I will say is the direction of demand, particularly from solar installation at scale and AI hardware build-out, has not reversed. In the UK context, the North Sea energy transition and the UK government's solar rollout targets represent exactly the kind of medium-term structural demand that does not show up in weekly price moves, but does show up in multi-year supply and demand balances. I am not going to give you a precise ounce per megawatt figure, because that would be false precision, and you deserve better than that. What the data shows is direction, and the direction has not reversed. If you have stayed with me this far, what comes next is the part that actually changes how you read these markets going forward. The 3 lanes framework, the one call I am putting on record for this week, and a completely straight bull versus bear breakdown with no thumb on the scale. All right, let me show you how I am actually thinking about this week using the 3 lanes framework. This is how I separate what is noise from what actually matters. Lane 1 is the paper market, blue on the graphic. This week, COMEX backwardation with May futures at $90.40 against a $94.50 spot price. The CFTC commitments of traders report, Creator verified the most recent Friday release date and figures, will tell us where managed money net long positioning sits right now. That positioning number is critical context for understanding how much fuel is left in the short covering tank if this moves higher. Lane 2 is the physical market. Silver on the graphic. This week, the 18.5% Shanghai premium, COMEX registered inventory drawdown, and whatever your local dealer is telling you about premiums and wait times. If physical premiums at the retail level are rising alongside the Shanghai premium, those two signals together are much stronger confirmation than either one alone. Lane 3 is macro, gold on the graphic. This week, DXY at 97.61, 10-year yield at 3.96%, Middle East geopolitical risk premium active, and central bank buying trend intact. In 15 years watching currency and commodity markets, the times I've seen all 3 lanes align in the same direction, even briefly, have historically been some of the most significant moments in these markets. I am not saying we are there today. I am saying it is worth knowing what to watch for. When the paper lane is showing backwardation, the physical lane is showing premium expansion, and macro is providing a structural tailwind. The historical pattern has been that one of those lanes eventually pulls the others toward it. Which direction that resolution happens is what the bull and bear case comes down to. That is a framework, not a forecast. You decide what to do with it. Here is the one thing I am personally watching this week. One thing. The CFTC Commitments of Traders report releases on Friday. I am watching managed money net long positioning, in silver specifically. If net longs have collapsed to a multi-month low, which the backwardation and the paper physical disconnect suggests is possible, that means a hedge fund community is either already short or significantly underweight silver going into a weekend geopolitical spike. That setup historically creates the conditions for a short covering rally that can move fast and move far. The threshold I am watching. If managed money net longs are below the 6-month average when the report drops Friday, I will be flagging it in next week's video as a potential setup. If they are at or above the 6-month average, the short covering story weakens considerably and the bullish case becomes harder to sustain on paper market dynamics alone. This is my one call for the week. John, FX Insider. On record, I will be back next video to tell you exactly what happened. No edits, no excuses. That is the only way this works. Now here's where I want to be completely straight with you, because this is where most channels pick a side and run with it. I am not doing that. Here is what needs to happen for the optimistic picture to develop. Chinese physical demand holds or accelerates. The Shanghai premium forces Western futures to gap up to close at $17.50 spread. Short covering on the COMEX creates a feedback loop. The DXY continues its current trajectory, and the geopolitical risk premium stays elevated long enough for the safe haven bid to become structural rather than reactive. If all of those things develop together, the silver move we have already seen could be the beginning of a much larger repricing. Here is what needs to happen for the cautious picture instead. The Fed surprises the market with hawkish language. The dollar recovers. Real yields rise. Margin requirements on COMEX silver contract get raised, which exchanges can do quickly and which historically has been one of the most effective tools for killing a commodity squeeze before it becomes a genuine crisis. Paper liquidations follow. Physical prices pull back even as the underlying demand story remains intact. And the Shanghai premium compresses back toward normal as Chinese demand proves more elastic than it currently appears. Both of those outcomes are genuinely possible right now. Your job is not to pick one and emotionally commit to it. Your job is to watch which conditions are actually developing in real time. The market will tell you. You just have to be watching the right things when it does. Before we close, the disclaimer you need to hear, and I mean it, everything in this video is educational content based on publicly available information. Currency Insider does not provide financial advice, investment advice, tax advice, or legal advice. Nothing here should be construed as a recommendation to buy, sell, or hold any asset. Past market behavior is not a guarantee of future results. Always consult a qualified financial professional before making investment decisions. Before the 2 questions, if you got value from this today, the like button takes 1 second, and it genuinely helps this channel reach people who are trying to navigate these markets without all the noise. Hit it now. I want to ask you 2 things, and I genuinely want your answers. First, are you currently holding physical silver, paper silver, or both? And has this week's move changed how you're thinking about that balance? Second, based on the 3 lanes framework we just walked through, which lane do you think is sending the strongest signal right now? Paper, physical, or macro? Drop both answers below. The comments section here becomes a real-time sentiment tracker, and I read every single one. Subscribe because next week we are going into the CFTC positioning data in detail. I'm going to show you exactly how to read the commitment of traders report yourself line by line, so you never have to take anyone else's word for what the hedge funds are actually doing. That is a skill worth having. And if someone in your life is watching their stack right now and feeling confused about what is happening, share this with them. That is the whole point of this channel. This is Currency Insider. Know the market. Protect your currency.